Okay, guys, so welcome to this class. This is FAC 4863, similarly FAC 4861. This is a CTA 2 question we're going to work through. So I was intending to work through test 3 of 2022, but I'm going to do a separate recording for that. I want to work through this question. So why 2022? What I want to work through is there's investment property, it has intangibles, and it has non-current as held for sale. Very important. But I'll already do that on a separate video. I want to work through this one because this is basically a PPE question. So PPE is a big topic, so we need to make sure that we are able to understand them. Today I'll also upload the, I will share with you, for those that are in the CTA2 mastermind, I'm going to share with you the all the videos that all the recorded videos that I have to date, basically. Might not have every single topic, but I have all the big topics. And then as we have more videos and more, I'll just add to that list. So automatically you will have the updated, all the updated videos and so forth. Okay, so I'm going to work through this as I'm going to work through part A, which is a journal. I'm going to work through required A, which is a journal entries question. Okay, but we're going to read through the scenario because the scenario is quite short. So we can read through the entire scenario and then we're going to work through it. As I work through it, I will explain to you the different concepts that are coming through, and then also a way of thinking through a question. Okay. So they say Enjoy SA operates in the leisure and tourism industry. Enjoy SA is a South African company with a 28 February year end. It has two significant assets, namely the Stimela luxury train and a small office building in Cape Town. Its other assets comprise inventories and trade receivables. Inventories are measured at the lower of cost or net realizable value. Okay, so here they're just giving you an idea. They basically, in which industry they're in, leisure and tourism. Okay, important point, have a year end of 28 February. So that means we're running from 1 March to 28 February. Once you identify the financial year, write it down somewhere where it's easy for you to see. Don't try to keep it in your head, okay? So we know we're going 1 March to 28 February. So now you know they basically have two significant assets, which is a luxury train and a office building. Then they have other inventory, other assets, which is inventories and trade receivables. Okay, so just keep note of that. So basically the luxury train and the office building is most likely going to be PPE. And then we have other assets, which is inventory and trade receivables. Now, what's important to take note, when you're dealing with assets, right? At this point, after this, after test 3, you will basically have covered all the assets that almost all the assets, right? So take note of the standards that it deals with assets. So it would be PPE, so IAS 16 PPE. It would be IAS 38 intangible assets. It would be IAS 40 investment properties. Then it would be IAS 2 inventories. Okay, so those are the 4 big topics. Okay, then the 5th one would be IFRS 16 leases, right? And then the 6th one would be IFRS 9 financial instruments. Now, if financial instruments deals with both assets and liabilities. So for an assets, it will be financial assets. IFRS 16, but you must take note, particularly for lessees, it would be rights of use assets. Okay, so you want to make a list of the assets that you deal with. Then there are other topics that also impact assets. So for example, IFRS 5, non-current assets held for sale, as well as IAS 21, which is borrowing costs. Okay, so those ones, you must just take note of the standards that deals with assets. So the big ones is going to be IAS 2 inventories, IAS 16 PPE, IAS 38 intangible assets, IAS 40 investment properties. Then don't forget IFRS 9 financial instruments, particularly financial assets, and then IFRS 16, which is leases. Okay, so you must be able to have that thought process in your head. So why this is important? So for example, let's use a building. Okay, so the question, a company has a building. How are you going to classify this building? So now we identified that the building is an asset. So when you want to speak about whether you have an asset, a liability, or equity, that you determine based on in terms of the conceptual framework. Okay, the conceptual framework is sorry, I lost you guys. So I'll just explain where I think I lost you. So I was saying you must think always in terms of your assets, right? Your different types of assets, you must always keep that in mind, okay? So I was saying, let's say a company has a building, okay? So we identified that the building is an asset. So what's very important to understand, when you want to determine whether something is an asset, a liability, or equity, then you use the conceptual framework. The conceptual framework is not an accounting standard. The conceptual framework is just a framework, and that will help you to determine whether you have an asset, a liability, or equity. So it's very important to understand that and identify that clearly from a question, okay? So now we established that the company has an asset, and this asset is a building. Now we need to determine how we're going to account for this building in terms of an accounting standard. So when you're looking at an accounting standard, it either be inventories, PPE, and all of those type of stuff. Okay, so the conceptual framework is not an accounting standard. The accounting standards is all the other standards, if I can put it that way. So now we know we have an asset, which is a building. The question is, how are we going to account for this building in terms of an accounting standard? So one of the ways to think through this is to identify all the standards that deals with an asset. Okay, so like I said, IS2, PP, intangible assets, investment property, and so forth. Okay, so now we're going to go through this. Okay, so would a building be classified as inventory? Would a building be classified as intangible assets? Would it be PPE? Would it be investment properties? Would it be IFRS 9 financial assets? So we know a building can't be IFRS 9 financial assets because it does not meet the definition. We know the building can't be I-38 intangible assets because it does not meet the definition. A building is tangible, so automatically it has physical substance, so automatically it can't be I-38 intangible assets. So we kind of left with inventory, PPE, and investment property. So now it all depends on what the definition of those standards are. So for investment properties, in order for a building to be classified as investment property, it must meet one of the two definitions. One, it must either be held to earn rental income, or it must be held to earn capital appreciation, or both. Okay, so if it meets one of those or both of those, then it can be investment property. If for a building to be classified as inventory, it must be sold in the ordinary course of business. So if a company is in the business of buying and selling buildings, like a real estate agent, then it can be classified as inventory. If it's not inventory and if it's not investment property, then it will be PPE. So it will be PPE because a building is a long-term asset. It is tangible. If it's owner occupied, if it is used in the production of income, then it, like for example, it is in the production of income, it would be a factory, it would be a retail store or something of that nature. Then it would be PPE. If it is if an office building is owner occupied, okay, so like your head office building is owner occupied, so then it also becomes PPE. Okay, so that is basically how you need to think about it. Okay, so just keep that in mind. Okay, so here we can see it is an office building. So this would be it's an office building, so it's most likely going to be PPE, a luxury train. We'll see what they do with this luxury train to determine whether it is PPE or something else. Okay, so they say Stimela is a luxury train operated by Enjoy SA, running on routes between Cape Town, Johannesburg, and Victoria Falls. Historically, approximately 60% of Stimela's passengers have been non-South African residents. However, because of the strengthening of the South African rand in the past few years, the number of non-resident passengers have steadily declined. This decline has not been compensated by an increase in the number of South African resident passengers. Okay, so this kind of indicates there's a potential impairment. Okay, so when it comes to impairment, IS38, it is, IS36 impairment. When it comes to IS36 impairment, there are two types of indicators of impairment. Internal or external. Okay, so this is an external indicator. Okay, so the rand strengthening, meaning the value of the rand relative to the value of the rand relative to, let's say, USD or another currency is becoming more expensive for the foreigner, but better for us. Okay, so just take note of that. So then they say, Enjoy SA acquired the newly manufactured train on 1 March 2005 from the manufacturer at a cost of 62 million rand. The train had an estimated useful life of 10 years, after which Enjoy SA expects to purchase a new train. At initial recognition, Enjoy estimated the residual value of the train to be 12 million rand. This estimate was not revised by 29 February 2012, and the company still intends to sell the train on 28 February 2015. Okay, so 10 years, so 1 March 2005 to 28 February 2015 is 10 years. Okay. So they say the manufacturer of Stimela train maintains records of resale values of various trains. At 29 February 2012, the resale price of trains of the same make and model as Stimela were as follows. 10-year-old trains were selling for that amount, and 7-year-old trains were selling for 16 million rand. The cost of selling the second-hand trains are negligible. So this information is just basically indicating information relating to impairment. Okay, so we will talk about that now. The carrying value of the train has not been reduced for any amounts other than the annual depreciation charge, which is calculated at the end of each financial year. No journal entries have been recorded regarding the train for the year ended 29 February 2012. So it indicates that our financial year is 2012. So we'll confirm that just now. That basically it will probably be 1 March 2011 to 29 February 2012. The South African, so SARS grants Section 11E on the income tax, wear and tear allowance on the train over a 12-year period. Prior to finalizing the financial statements of the company for the year ended 29 February 2012, executive management had to present budgets for the next 3 years, for the next 3 financial years, to the board of directors. So this will probably be information for value in use. Okay. So here we have the following budgets were approved by the board for the Stimela operation. Okay, 29 February, this is our current financial year. So then we have budgeted information. So they say cash revenue. So that's what they budget for, cash revenue from the trains. Cash operating costs. This is what they estimate. Then they want depreciation. They're taking into account depreciation. And then they have total. So total expenditure comes to that. So the pre-tax loss on the profits are those. Okay, so just take note. When we want to work out a value in use, we're only interested in cash flows. Okay, so we want to work out value in use, we're only interested in cash flows. So when we use this number, we'll have to remove the depreciation. Okay, and we are interested in a pre-tax amount. So these amounts are before tax, so it is fine. So they say the above estimates include the effects of price increases attributable to general inflation. All operating costs are in ZAR. For calculation purposes, assume cash flows at the end of each year. Okay, the following discount rates are applicable to investments equivalent, okay, pre-tax ZAR. So we want a pre-tax rate. So now they say including the effect of inflation, excluding the effect of inflation. So because these amounts includes the effect of inflation, we must use a pre-tax rate that also includes the effect of the inflation. Okay, so that's important. If the amounts are based on nominal, then your tax rate must be nominal. If the amounts were real, then your tax rate must be real. So because it includes the effect of inflation, it's a nominal values. So therefore, we will use the pre-tax rate of the nominal pre-tax rate. So just take note of that. Very important. If they gave us an after-tax amount, we must always use a before-tax amount. Okay, so that's very, very important to take note. Okay, so then they say the normal tax, okay, 28 and subject to 80%. Okay, so I just want to see if we need to read this. So they want to prepare the journal entries to correctly account for the stimuli train in the 2020 financial statements. Okay, they say journal entries regarding deferred tax are required. Okay, so what we're going to do with this is basically deal with part A. Then they say calculate the revised budgeted depreciation charge for stimuli for the year ended 28 February 2013. Okay, so we'll have to have a look at that. I just want to see quickly. So let's have a look. We're going to work through this information now, and then we can, so I'm going to do part A. So remember, we need to do the journal entries for the year ended 29 February 2012. So that means it's 1 March 2011 to 29 February 2012. Okay. So how many are we over here in this group? We are 3. So what I'm going to do is I'm going to put all 3 of you in the same group, and then see if you can come up with journal entries. Okay, I'm only going to give you 10 minutes, and then we're going to go through it together. Okay, are we happy with that? Okay, so we're happy with that. Didn't hear any indication, but anyway, I'm assuming you are. I just quickly want to put you in groups. Okay, so you guys can join the groups. I'll share the calculator in the group now. Okay.
to show the effects of deferred tax, because I noticed that they also provided us with the SARS tax rate for wear and tear. Yeah.
Oh yeah, there's the
How are you guys doing?
deferred tax. Hi there, Faiz. Yeah, we just going through the question now, through the journal entry. Can you hear us, Faiz?
Yeah. The wear and tear is 12 years.
Okay, so can you take me through what you guys went through? Then we're going to answer it now.
Yeah, I think Kennedy can take you through, please.
Looks like I can't hear you guys again. Okay, anyway, I'm not sure what is the
Can you
problem here.
can you hear us, Faith?
Do you wanna, Kennedy or Nasibi, just speak again, see if I can hear you. You can hear me, right?
Can you? Yes, I can hear
Okay, I
you.
can
We
see
can
you guys
hear
are
you,
talking,
yes.
but I can't hear you. Okay, it's fine. So let me go through it, and I'm going to, let me just open up Excel. Let me just open up Excel. Then we can go through it now. Okay. Sorry, I need to see it. I'm not sure how come the thing is not. Okay, so you can see my stuff, right? Okay. So what we have to do, if we have a look at the required, so if we have a look at the required, we need to prepare the journal entries to correctly account for the stimula train in the financial statements of Enjoy SA for the year ended 29 February 2012. Journal entries regarding the related deferred tax effects are required. Okay, so 1 March 2011 to 29 February 2012. So so basically what we need to do is basically record the depreciation. So remember there was no additions or disposals. Okay, so there's no additions to record, there's no disposals to record. Okay, so there'll be depreciation. So that's the one journal entry. Because there was an indicator of impairment, we need to do an impairment test. Once we do the impairment test, we will then determine whether we need to process an impairment journal entry. So that would be the second journal entry if there is an impairment. And then number 3, we need a deferred tax journal. Okay, so basically there are at minimum 2 journals, at most 3 journals. Okay. So so you need to just think about the possible journal entries that could take place, right? So additions, there's no additions. Disposals, there's no disposals. Borrowing costs, there's no borrowing costs. There's no transfers from PPE to a non-current assets held for sale. There's nothing of that. Okay, so therefore, it's simply going to be your depreciation. There's a potential impairment because there was an indicator of impairment. Because there was an indicator of impairment, we need to do an impairment test. And the impairment test will tell us whether we have an impairment or not. And then deferred tax. Okay, so just take note of that. So basically, the first journal entry would be, you should be able to see Excel. If you don't, just raise your hand. So you should be able to see Excel. So the first journal entry would be depreciation. Okay, so our date is going to be 29 February 2012. Okay, so everything will happen on 29 February 2012. There was nothing that happened throughout the year. So depreciation, deferred tax, and an impairment will happen at the end of the year. Okay, so therefore everything will be at this date. So we know we're going to have a depreciation charge, and then it's going to be accumulated depreciation. Okay, and then we will just simply have the statement. Debit, credit. Okay, so this statement is going to be P&L, this statement is going to be SFP. Okay, so there we go. So we're happy with that. So now we can have our debit and credit. Okay, so there we go. Okay, so now we basically need to work out the calculation. So we need to work out depreciation. Okay, so now remember, in this question, there is a change in estimate. Okay, so remember for PPE, there'll be two types of change in estimates, typically, the useful life, and then the residual value. The useful life did not change, but the residual value did change. Okay, so remember, if we go back to this question, or if we go back to the question over here, if we go back to this question, so the residual value at initial recognition was 12 million, but now we can see your different depreciation with other residual values. Okay, so for 10-year-old ones is a 7 million, and for 7-year-old trains is a 16 million. Just give me 2 minutes. Just going to be someone at the gate. Okay, I'm back. So we might just take note of that. Okay, so here is two residual values that we need to take into account. Okay, so because there's a change in estimate, what we'll have to do when there's a change in estimate, we can't simply use the original depreciation a yearly amount. We will have to work out the carrying amount at 28 February 2011, and then the depreciation for the new for this financial year, the current financial year, needs to be calculated taking into account the change in estimate. Okay, so that's very important to understand. So let's have a look. So we need the depreciation for the financial year ended 29 February 2012. We know there's a change in estimate, okay, because the residual value was 12 million. Now the 10-year residual value is 7 million, okay? So what we'll have to take into account is the change in estimate. In order to calculate the change in estimate, we will have to work out the carrying amount at the beginning of the current financial year, and then work out the depreciation using the carrying amount at the beginning of the financial year, using the new estimate, which is the new residual value, and then using the remaining useful life. Okay, so we're not going to use the total useful life. When there's a change in estimate, we use the remaining useful life. Okay, so let's work out the amount. Okay, so I'm going to put in my workings over here. Yeah, I'm going to have workings. Okay, so my remaining useful life. So I'm going to work out depreciation for the current financial year. But to do that, I need the carrying amount at the beginning of the financial year. Why do I need the carrying amount at the beginning of the financial year? Because there was a change in estimate. Okay, so the cost price. So the cost price is I think it was 60 million. You could check. Cost price was 62 million. Okay, so the cost price is 62 million. So there I'm going to go 62 million. Okay. Residual value initially. Residual value. Residual value initially, okay, was 12 million. Okay, let me just make sure I got the numbers right. Yeah. Okay, so now we have our depreciable amount. Okay, depreciable amount. So the depreciable amount is going to be 62 minus 12, which is 50. Then I'm going to have which is 50. So now I'm going to say total useful life, okay, which was 10. So my annual depreciation is 50 divided by 10. Okay, so there we go. So annual depreciation is that. Okay, so we're happy with that. So now we need the carrying amount at 1 March 2011. Okay, so I'll go costs, accumulated depreciation. Okay, and this so this is going to be 1 March 2005 to 28 Feb 2011. Okay, so remember we need the carrying amount at the beginning of the financial year. The beginning of our financial year is 1 March 2011. So therefore we stop at the end of the previous financial year. Okay, so that is basically that over there. And then this will give us our carrying amount. This will be carrying amount. Carrying amount 1 March 2011. Okay, that's the beginning of the current financial year. So we know the cost price is 62 million. Okay, accumulated depreciation from 1 March 2005 to 28 February 2011. So it is 2006, 2007, 2008, 9, 10, 11. Okay, so let me just count again. So 1 March 2005 up until 1 March 2005. Yeah, so 6 years. Okay, so therefore, this is going to be equal to 5 million multiplied by 6 years that have passed. Okay, so 5 million, which is that annual depreciation, times the 6 years that have passed. So I'm going to say 5 million. I'm going to say 5 million multiplied by 6. Okay, so that is 30 million. So my carrying amount, costs minus accumulated depreciation, 32 million. Okay, now that we have the carrying amount at the beginning of the year, now we can work out depreciation for the current financial year. The reason why we have to go through this approach is because there was a change in estimate in the current financial year. So remember, two things can change, either your useful life and or your residual value. In our case, only our residual value changed. Okay, so the way we're going to work this out, we still use the same formula, cost minus residual value give me depreciable amount divided by useful life. But in this case, our cost price is going to be our cost price our cost price is going to be 32 million, which is the carrying amount. And our residual value, which is the change in estimate, we have to choose the correct one. And then we're going to use our remaining useful life. Okay, so now we're going to have again a residual value. Okay, so I'm going to put that there. The brackets you don't have to do. I'm putting in the brackets, so just for explanational purposes. Okay, so this is the new estimate. Okay, and then again, we're going to have depreciable amount. Okay, and then we're not going to use total useful life because, so in the first one, we use total useful life. Why? Because we use the original cost. Because we are using the carrying amount, we can't use total useful life. We have to use remaining useful life. Okay, so those are important things to take note. And now we will be able to work out okay, so that is going to be, so now we'll be able to work it out. Okay, so now let's go and choose our residual value. So how do you choose your residual value? Is based on the definition of residual value. Okay, so it's based on the definition of residual value. Okay, so the definition of residual value is saying it is the estimated selling price at the end of the useful life, okay, at the end of the term. So our useful life remained the same, which is 10 years. So it's basically what we would get at the end of the 10-year period. Okay, so what we would get for a 10-year trade in the same condition and all of those type of stuff. So therefore, when we go to this question over here, you can see the manufacturer of Stimela trains maintains records of resale values of various trains. At 29 February, at the end of the current financial year, the resale price of trains of the same make and model as Stimela were as follows. So for 10-year-old trains, it will be 7050. For 7-year trains, it will be 16 million. So because at the end of our useful life, our train will be 10 years old, so therefore we'll have to use that amount over there. Okay, so the new estimate is not 16 million, it is 7050. 1, 2, 3. 7050. Let me just see quickly. Okay. Okay, so therefore our depreciable amount is 224,950,000 rand. Now we need to work out our remaining useful life. Okay, so remember, we have a 10-year, our useful life remained at 10 years, total useful life remained at 10 years. 6 years have passed, so therefore the remaining useful life is 4 years. Okay, so therefore remaining useful life is 4 years. So remember, you must include the current financial year. So it is 2012, 2013, 2014, 2015, which is 4 years. Okay, so therefore our annual depreciation is no longer 5 million, it is now 6.2 million. So our depreciation is going to be equal to 6.2 million. Okay, so that is going to be working 1. Okay, so just take a moment to process that, and then we will. So just take a moment to process that, and then we're going to, and then we go. Then let me know if you have any questions. I'll give you 1 minute. Yeah, do you guys have any questions? Any questions? Let me just see in the chat. Nothing. Yeah, just raise your hand if you have any questions. Okay, let me just see. Not yet. Okay. So now, so that is the depreciation. So remember, you must think about the possible journal entries that can go through. Okay, so with CTA level 2, you deal with non-current assets held for sale. You deal with borrowing costs. So there's no non-current assets held for sale in this question. There was no borrowing cost in this question, so we know that is out. Okay. For, let's say it was a building, then there could have also been a change in intention from PPE to investment property. There's nothing of that nature because it's a train. Okay, so investment property can't come in. So we know we don't have those transfers. Okay. Then for CTA level 1 and CTA level 2, change in estimates is a common thing. So in this case, there was a change in estimate, either useful life or a residual value. Okay, so in this case, it was a residual value. So I'm just think about the possible journal entries. Other than that, it'll be typically depreciation, additions or disposals. No additions, no disposals. So therefore, we have only depreciation. But now, CT level 1 and CT level 2, we have this thing of, I cannot remember if impairment in CT level 1, but definitely in CT level 2, we have an indicator of impairment. Okay, it was an external indicator of impairment that they're having less sales because of the strengthening of the rand. So it's an external indicator of impairment. So we have to test for impairment. Okay, because there's an indicator of impairment, we have to test for impairment. Okay. Yes. Yeah, for 30 years as well. So because of that, now we will have a applicable for everyone, yes. So now we can have an indicate. So because there's an indicator of impairment, we have to test for impairment. Okay, so the way we test for impairment is as follows. Oh, sorry, this journal entry is not complete. So there we go. Okay, so now we're going to test for impairment. If there is an impairment, we will have a journal entry for impairment. Okay, so the way we test for impairment is as follows. Okay, so we're going to say carrying amount yes, the recording will be available. Okay, so carrying amount at the year end, which is 29 Feb 2012. Okay, then we're going to need a recoverable amount. Okay, recoverable amount also 29 Feb 2012. Okay, so recoverable amount. Okay, so we need the carrying amount and the recoverable amount at that date. Okay, so now remember, we can work out the carrying amount. Okay, so this would just simply be that. Okay, it will simply be that. It simply be that. Then it will be depreciation. FY 2012, which will be that. Okay, so our carrying amount at 29 February 2012 would be that amount over there. Okay, so that is going to be working 1. Okay, so now we need to work out our recoverable amount. So now we need to work out our recoverable amount. So remember, a recoverable amount is higher of. Okay, so the recoverable amount is the higher of. The recoverable amount is the higher of value in use and fair value less cost to sell. Okay, fair value less cost to sell. Okay, so that is our recoverable amount is the higher of those two. Now, the fair value less cost to sell is the amount you would get for selling the item today. Okay, so it's the amount you'd get for selling the train on 29 February 2012. At 29 February 2012, the train would have been 7 years old. Okay, so therefore, we can have a look over here. At 29 February 2012, the train would be 7 years old, so the selling price is 16 million. They told us cost of selling is negligible, so there's nothing. Okay, so therefore, we will simply go over here and say fair value less cost to sell 16, 1, 2, 3, 1, 2, 3, minus 0, which is negligible. So therefore, it is 16 million. Now we need to work out fair value, value in use. Now we need to work out value in use. So that will be working 3. Okay, so now we're going to do value in use, which is working 3. Okay, so I'm going to go here, working 3. Okay, so now we will work out value in use. Okay, so for value in use, we must work it out. They gave us a budget. Okay, so they gave us a budget, so we can simply make use of that budget. So let's have a look. Let me just quickly have a look over here. Where is this now? So now we can make use of this budget. Okay. So now we're going to use this budget. So now let's have a look. Okay, so we're going to have details. Okay, it's going to be year 0. Okay, year 1, year 2. They gave us 3-year budget. Okay, so this is basically 29 Feb 2012. Okay, I'm just going to say equal to okay. So 28 Feb 2013. Okay, so there we go. So all of this is how we want it. Okay, so I'm going to put in the same. I'm going to put in the same line items. I'm going to use the same line items. So cash revenue, cash operating costs. Okay, cash revenue, cash operating costs. Cash revenue. So cash revenue. Okay. Cash operating costs. Okay, I'm going to make a note over here. Excluding depreciation because non-cash flow. Okay, when you exclude something, you have to tell them. Okay, non-cash flow. Okay, so therefore we must tell them that. Okay, then what you must always remember, you must put in, I was going to share, you will be able to see it now. But so here they're saying, estimating the value in use of an asset involves the following steps, involves 2 steps. Estimating the future cash inflows and outflows. So the cash inflows are cash revenue, and the cash outflows are cash operating costs will be derived from continuing use of the asset and here's important, and from its ultimate disposal. Okay, so we must include the disposal amount, applying the appropriate discount to future cash flows. Okay, so we must include the disposal. Okay, so ultimate disposal. Okay, so that's very, very important. Okay, so we must include the ultimate disposal. So now let's have a look. Okay, so if I go to the question again, so it is 15.8, 16,600, 17,400. Just help me remember that. So it is 15,800, 16,600, I think, and 17,400. Let me just go check again. Okay, 16,600, okay, 17,400. Okay, then it is that 11,4, 11,7. 11,4 and 11,7. Okay, make that negative. Okay, 11,400, 11,700. Okay, so it's important to take note, why are we not including 29 Feb 2012? Because remember, the one future cash flows. Okay, year zero have already passed, so the future is only over here. That's very important. Okay, so now we must include the ultimate disposal. So remember, for a 10-year item, so for a 10-year-old train, at 28 February 2012, they told us the current selling prices. Okay, so very important. They told us over here. So the current selling prices. Okay, so the prices currently. Okay, at 29 February, a 10-year-old train will be sold for 7,050. Okay, so a 10-year-old train today will be sold for 7,050. So because if we had to sell the 10-year-old train today, we will get 7,050, 1, 2, 3. Very important to identify. Typically, someone would have maybe included it over here. Someone would have included it over here. Why don't we include it in at 28 February? Because it's not the price we're going to get at 28 February 2015. It's the price we're getting today. So therefore, it is in year zero. So that's important to be able to pick up. Okay, very important to be able to pick up. So there we go. So now I can work out cash flows. Okay. Cash flows, which is going to be equal to sum just take note of that. It was in rand thousands. So we need to make sure we put it in full amounts. So let's just go back. The budget was given in rand thousands. So we must make sure we put the full amounts in. Then we're going to go discount rate is 15%. So we're going to tell them using nominal rate because cash flows are at nominal values. Okay, so there we go. Now we can work out present value. Okay, so now we can work out present value. Okay, so present value, cash flow, year zero. Okay. Value in use. Okay, so what you might just take note, Excel and Google Sheet, and so whether you use Google Sheets or Excel, it doesn't factor doesn't take into account the cash flow of year zero. So therefore I show a thing, I'm going to show it separately. If you use a financial calculator takes into account year zero. So then you don't include my step over here. Okay, but if you're using Excel, you will have to include this step because Excel does not include year zero. So just have a look. I'm going to say equal to NPV. Okay. So it's asked me for the rate, which is 15%. If you have a look over here, you can see it's asking for value 1, then value 2. It doesn't ask for value 0. Okay, so therefore, when I'm going to select from value 1 until the last value, which is value 3. Okay, so because of that, I have to include the cash flow year 0 separately again. Okay, but if you use a financial calculator, you will type into your financial calculator value 0. So therefore, you won't have to add up what I'm doing over here. Okay, so when you do your calculation would have already come to 18,662 because you would have already included the 7 when you do your when you do it in terms of the financial calculator. Okay, so just take note. So now my value in use is 18. Okay, my value in use is 18. So therefore, RA is the higher of the two, which is going to be that one. So therefore, my recoverable amount is 18,662. Okay. So now because so carrying amount greater than recoverable amount, therefore impair. Okay. If the carrying amount is greater than the recoverable amount, you will impair. If the carrying amount is less than the recoverable amount, there is no impairment. Okay. So impairment is going to be the difference between the two. The carrying amount exceeds the recoverable amount, so we must reduce the carrying amount to the recoverable amount. Okay, so that is C37. So therefore, we will have an impairment. So we're going to have impairment. Okay, you can call it accumulated depreciation as well, or you can call it accumulated impairment, doesn't matter. Okay. So this is going to be equal to C37. Okay. Okay, so where you can find that at working 2. Okay, now all we have to do is the deferred tax journal. Okay, so all we have to do is the deferred tax journal. Okay, so we're gonna have to do one for 2020 for 28 February 2012 as well as 28 February 2011. Okay, so 28 February 2012, 28 February 2011. So working 4. Okay, so I'm gonna have account or asset, liability. Okay, we're gonna need carrying amount. We're going to need tax space. Then we're gonna need temporary difference. Then we're gonna have deferred tax, okay, at 28%. Okay. Okay, so 28%. Okay, and this is going to be 28 Feb 2012. Okay, so all we have sorry about that. Okay, so now the only thing we have is basically the PPE train. Okay, PPE train, the Stimela train. The carrying amount at 29 February 2012 is what we calculate is basically it is the carrying amount minus the impairment, right? Which is basically our recoverable amount. Okay, so our train will be the recoverable amount, which is the 18 million. Now we need to work out the tax base. Okay, the tax base, SARS do not take into account residual values. They depreciate over a 12-year period. At 29 Feb 2012, 7 years have passed. Okay, so basically it's going to be 62 million 123 123 multiplied by divided by 12. How many years have passed? 7 have passed. So therefore, the remaining period is basically 12 minus 7 have passed. So they have a 5-year period. Okay. So therefore, we have that amount over there. So they don't have that. The temporary difference is that minus that. So therefore, deferred tax would simply be that multiplied by 28%. Okay. So it's 12 years, 7 years have passed, so 5 years remaining. Okay, so that is fine. Okay. Now we must do the same. We must do the same for we must do the same for 29 Feb. I mean for the beginning of the year. Okay, so we must do the same for 28 Feb 2011. Okay, this must be 29. Okay, so the carrying amount at 28 Feb 2011, we already calculated it in working one, which was 32 million. Okay, we use the same formula over here for that, but at 29 Feb, 6 years have passed. So therefore, that is the carrying amount. So now we can work out the deferred tax. Okay, so the movement, actually, let me just quickly do this. Control X, Control V. Okay. So therefore, the movement for the period, movement is as follows. Okay, so the movement, you simply just say closing balance minus opening balance. So the movement is 2287. Okay, so 2287. So over here, we have a deferred tax liability. Over here, we have a deferred tax asset. Okay, so over there, we have a deferred tax liability. Over here, we have a deferred tax asset. I'm not going to go into the explanation on that. I'll do it in another time. Okay, so therefore, over here, we need to get to a deferred tax asset. So deferred tax is all we're going to do over here. We're going to have to debit deferred tax. So we're going to say deferred tax SFP. And then over here, we're going to say, I think we're going to call it income tax, P&L. Okay, and it's simply going to be that amount, this movement amount. Okay, so it's simply going to be that over there. Okay, so that is basically 20 marks out of the 14. Okay, so that's basically 20 marks out of the 14. So this would basically be the journal entries. Depreciation as normal, deferred tax as normal. Obviously, they require a bit of a workings, and then impairment, because there was an indicator, and the indicator, and so we performed an impairment test. This here is an impairment test. This is an impairment test over here. Okay, this is the impairment test. So the impairment test revealed that the carrying amount is greater than the recoverable amount. So therefore, there is an impairment. Okay, so that is basically that. Any questions? Kennedy, any questions? Nasipi, any questions? Okay, perfect. No, so sorry. I still need to wait for your. Any questions from Kennedy? Do you have any questions? Let me just see what's happening in the chat. So no questions. Recipe, Kennedy. There's no questions. We guys are good to go. I'll give 1 minute just in case you're typing out something. Otherwise, I will. Okay. Guys, I will add the recordings later today. I'll see you guys tomorrow. Tomorrow will be a similar time because I'm having load shedding again. According to the currently based on the current load shedding schedule, I'm having load shedding at 8 again tomorrow. Okay. Thank you very much, guys. Bye-bye.